The more value your money could buy. So what is inflation? Inflation is a rise in prices, and that devalues your money. What causes inflation? Well, there's different types of inflation. A lot of people think, like, if coffee goes up in price, that's inflation. That's actually not inflation. That's just the price of a cup of coffee going up. Inflation is the price of all goods going up. And what causes that? Economists think there's several things that cause it, but one of the things that we know causes inflation is the printing of money. You think if 1 over the price level is the value of your dollar, like 1 over $10 would be the value of $1 in a Subway to purchase a meal. If government prints money and gives it to people, that should make that money less valuable because now there's more money, and thus the way you make money less valuable is the price has got to rise. So that's what causes, that's one of the things that causes inflation, is printing of money. Now, who controls the money supply? Where does that come from? Dr. Smith is an expert on the Federal Reserve. He's written books on it, and he's going to tell us a little bit about the Federal Reserve and its role in the money supply. Dan, come on up.
All right. Thank you, Stuart. It's a good introduction to inflation. It is a kind of a weird title for me because usually my research is on how the Federal Reserve does not work. But even a harsh critic of the Federal Reserve can look at the current PCE releases, and we have a new one being released on Friday that we're looking forward to, and admit that we have a soft landing here that is exceeding expectations, that it seems like inflation has been able to have been brought under control. Now there is, when we talk about how the Federal Reserve works, there was a major shift in how the Federal Reserve conducts monetary policy. In 2008, the Federal Reserve was given a new power to pay interest on reserves, and kind of quietly and unassumingly, the Federal Reserve started using that power. And what they did is they actually made that the primary, probably not by choice, but kind of stumbled into making that the primary way in which they conduct monetary policy. And this has had major changes. It's taken the power of the previous way they conducted monetary policy was primarily through the buying and selling of government bonds. This was controlled by the Federal Open Market Committee, which had broader representation that included some branches from the 12 Federal Reserve banks. But now the interest on reserves is their primary tool, and that is just controlled by the Board of Governors, who are appointed by the President, approved by the Senate. So there has been some major changes in how that's conducted. I still don't think financial journalists and people following the Fed fully understand and appreciate that we have now moved on to, rather than a target rate policy, interest on reserves policy. So the Federal Reserve will conduct monetary policy. What they do is they look at broad measures of the economy, broad representation from different Federal Reserve banks across the United States. How's the labor market doing? How's inflation? How are our business starts? How are our home mortgages? New housing starts? Just a broad array of data. And what they do is they come together, and the most recent meeting was in the middle of September, and they have a new meeting coming up, I think it's November 6th. And what they'll do is they'll look at that, take into account all that data, use their theoretical models to examine it, and make a decision for how they think they should conduct monetary policy until the next meeting, taking into account all these factors. And the latest meeting, what they did is they release a projection every 2 meetings on what they think the inflation rate will be. The last meeting, they were projecting that the inflation rate would be brought down to 2% by 2026. But depending on how this most recent PCE release comes out on this Friday, they may be lowering that or increasing the speed to which we obtain that. Now, what's really interesting is prior to COVID, right at the beginning of 2020, the Federal Reserve had a whole year-long listening tour. They talked about changing their way they're going to operate monetary policy. And they made a huge announcement and said, we're going to transition to average inflation targeting. So they're going to say if we cause inflation, we're going to make up for it by going lower than that. So I, at that time, thought it was very politically implausible that after a period of inflation, the Fed would actually go below their target rate. And I think that's going to come to bear. I think there's a lot of economists celebrating and saying, look, we've done it. We've brought it back down to presumably maybe even 2% with this new release. But I don't think there's any political will or economic will to go below 2% and make up for that average. So I think that's going to tarnish the reputation of the Federal Reserve to some extent, at least to the extent that they're willing to adhere to this average inflation rate target. By any definition of average, they are not going to make it. They were never explicit. They never said how long they were going to look and calculate that average. They never said how quickly they would make up for that average. But regardless, I don't think they're going to even attempt to do that. And we're just going to celebrate the 2%, which is fine. But I think there'll be the Federal Reserve will have to take some action internally to explain their new operating procedure, given that clearly they are not following an average inflation targeting model anymore. There's also some problems with average inflation targeting, particularly the supply shock problem, whereas if there's a positive supply shock, there's new innovation, the economy's doing really well, that makes inflation go down because prices are going down because of that new innovation. Well, the Federal Reserve would then increase inflation and juice up the economy at that particular moment. So I've never been a real big fan of average inflation targeting, and would actually prefer to see the Fed move to a nominal GDP targeting to stabilize a growth trend of nominal GDP, though that is certainly a more controversial position.
Can you tell us about who is on the Federal Reserve and how they're selected?
Yeah, so the Federal Reserve, the Board of Governors are selected by the President. They're appointed by the President and approved by the Senate. They serve 14-year terms, though oftentimes they never serve that long. And then there is a chair of the Board of Governors who's appointed every 4 years. So that ensures that each president will get to set and select that chair. And there's also a vice chair and some other official positions as well. The rest of the Federal Open Market Committee is selected by their 5 presidents of the 12 reserve banks. This gets kind of complicated, but there's 12 Federal Reserve banks across the United States. Ours is going to be Atlanta, though they have a regional headquarter in Nashville. So they take 5 of those 12 presidents, and 1 is always going to be the New York Fed, and they serve on this Federal Open Market Committee, which is the primary decision-making unit that everyone follows for how the Federal Reserve is going to operate. And legally, they're supposed to represent a really broad array of interest, labor, industry, from the founding that was written into the law. But increasingly, I think it's been taken over by academic economists, and even academic economists who are nominated by presidents from both Republicans and Democrats recently have been criticized for not being qualified despite having a PhD in economics, because they didn't have specialty in particularly monetary economics. So that has transitioned, and rather than, I think, representing a broad array, more of a democratic approach, it's certainly more of a kind of an elite approach. Let the experts do it. And there's good and bad to that.
Thank you.